Introduction to Security Analysis. Published in 1934, security analysis is considered the foundation of value investing. Benjamin Graham and David Dodd, both professors at Columbia Business School, wrote it during the Great Depression to help investors avoid speculation and make sound investment decisions. The book introduces fundamental analysis, where investors evaluate a company's intrinsic value instead of reacting to market fluctuations. The book is detailed, technical, and primarily aimed at serious investors, analysts, and financial professionals. However, its core principles apply to anyone interested in long-term investing. Core concepts of security analysis. Number 1. The difference between investment and speculation. Graham and Dodd define investment as buying securities based on careful analysis, ensuring safety and adequate returns. Speculation, on the other hand, is buying securities based on market trends, emotions, or predictions. Key message: investors should avoid speculation and instead focus on fundamental analysis. Number 2. The concept of intrinsic value. Intrinsic value is the true worth of a company based on its assets, earnings, and future potential. Market prices fluctuate daily due to news and emotions, but intrinsic value remains stable over time. Investors should compare market price versus intrinsic value and buy stocks when they are undervalued. Number 3. Margin of safety, the key to risk management. The margin of safety means buying securities at a price much lower than their intrinsic value. It protects investors from errors in judgment or market downturns. Example: if a stock's intrinsic value is $100, an investor should buy it at $70 or lower to have a safety cushion. Types of securities and their risks. Number 4. Bonds, fixed income securities. Bonds are less risky than stocks, but require careful analysis of a company's ability to pay interest and principal. Graham suggests looking at a company's earnings stability and debt levels before investing in bonds. Investors should avoid junk bonds or high-risk bonds with low credit ratings. Number 5. Preferred stocks. Preferred stocks are hybrids between bonds and common stocks, offering fixed dividends. They can be attractive for income investors, but Graham warns that dividends are not guaranteed, making them riskier than bonds. Number 6. Common stocks, equity investing. Stocks represent ownership in a company and have higher risks but greater potential for returns. Graham focuses on financial statement analysis to find undervalued stocks. Investors should study earnings stability, growth, and competitive advantages before buying. Key techniques for stock selection. Number 7. Quantitative versus qualitative analysis. Quantitative analysis examines financial statements, balance sheets, income statements, cash flow. Qualitative analysis evaluates management quality, industry trends, and business models. Both are essential for accurate stock valuation. Number 8. Earnings power and financial strength. Investors should focus on a company's earnings history, avoiding companies with erratic profits. Companies with consistent and growing earnings are safer investments. Strong balance sheets, low debt, high assets indicate financial health. Number 9. Dividends as a measure of value. Dividend-paying stocks are often more stable than non-dividend stocks. Companies with long-term dividend growth are generally well managed. However, investors should avoid high dividend stocks if the company has weak earnings. Defensive versus enterprising investors. Number 10. Defensive investors, conservative approach. Suitable for those who want low risk and steady returns. Should focus on established companies with long-term stability. Diversified portfolios, not concentrated in a few stocks. Dividend-paying stocks with consistent earnings. Number 11. Enterprising investors, aggressive approach. Suitable for those who can analyze stocks deeply. Should look for undervalued stocks with strong fundamentals. Special situations, mergers, distressed companies. Market mispricing opportunities. Number 12. The importance of market psychology. Graham emphasizes that investors should avoid emotional decisions and stay rational. The market often overreacts to news, creating opportunities for patient investors. Mr. Market concept. Imagine the stock market as an emotional person who offers to buy or sell stocks at random prices. Smart investors ignore Mr. Market's emotions and focus on fundamentals. Case studies and practical application. Number 13. How to analyze stocks step by step. Study the company's financial statements for at least 10 years. Look at profitability and revenue growth. Avoid companies with unstable earnings. Check debt levels. Avoid highly leveraged companies. Compare market price versus intrinsic value by when a stock is undervalued. Look at management quality and business model. Invest in companies with strong leadership. Legacy and impact of security analysis. This book influenced Warren Buffett, who studied under Graham at Columbia University. It laid the foundation for modern value investing and inspired investors like Charlie Munger and Seth Klarman. Although some concepts are outdated due to changing markets, the core principles remain timeless. Conclusion. Key lessons from security analysis. Investing is about research, not speculation. Intrinsic value is more important than market price. Always buy with a margin of safety. Focus on financial strength, earning stability, and dividend history. Ignore market noise and stay disciplined. This book is essential reading for anyone serious about investing. While it is complex, mastering its principles can help investors build long-term wealth with less risk and greater confidence.